November 2019, question 3C. Yeah, that's where we left in our last session. We're discussing on the taxation of business income. We discussed on taxation of banks, and we did 2 illustrations. Also, we discussed about taxation of insurance, and we even did 1 question. So now we have to do another illustration still on insurance company. Remember I said that for the insurance company, their major income are the premiums and their major expense are the claims. So now let's do that illustration. I think I had introduced everything. Eh? So we are told that Maisha Mema Insurance Company Limited provided the following information for the year ended that 1st of December 2018. So we have the gross premium received, we had the claims paid, commission ceded, commission accepted, claims recovered on reinsurance. Then we have the foreign exchange gain realized, dividend from life assurance fund, rental income on commercial building, bad debt provision. Then we have investment income. We have reserve for unexpired risk as at 1st of January 2018. Legal expenses relating to claims, agency fees, management fees, repair on rented properties, entertainment expenses, purchase of furniture, purchase of computers, reinsurance premium paid. Then we had the returned premium required. Additional information. Reserves for unexpired risk as at that 1st of December 2018 were 200,000. Remember, we said that reduction in reserves becomes an income which is taxable. An increase in reserves becomes an expense which is allowable. Now let's go back to the trial balance. Go back to the trial balance. In the trial balance, we had the reserves for unexpired risk as at 1st of January 2018, which was an amount of 1,000 or 1 million. Then now let's go to additional information number 1. Number 1, you are told that reserves for unexpired risk as at that 1st December 2018 were 200. Was it an increase or reduction? A reduction. A reduction by how much? 800, right? A reduction becomes an income which should be considered as a taxable income. Number 2, claims outstanding as at 1st of January 2018 and that 1st of December 2018 were 600 and 900. Now those are the claims opening balance and the closing balance. Number 3, premiums outstanding on 1st of January 2018 and that 1st of December 2018 were 601.2 respectively. Now those are the premium opening balance and the closing balance. Agency fees include 200 relating to life assurance business. Yeah, we see that we have 2 types of insurance business. One is general, the other one is life. So in case of life, that one does not affect. Then legal fees include 100 relating to the settlement of tax dispute. We also say that any expenses relating to tax are disallowable expense. Investment income comprised, there was interest from bank, then there was gross, interest from treasury bonds required. Taxable profit or loss of Maisha Mema Insurance Company Limited for the year ended that 1st of December 2018. So how do we present this? So this is Maisha Mema. Computation of taxable income. For the year ended that 1st of December 2018. Yeah, these are insurance company. So we start with their major income. See that their major income are the premiums. So you'll start with the gross premium received. Gross premium received, which was an amount of 30. Then we say that you add premium balance carried down, then you raise premiums balance brought down. Let's go to note number 2. Number 3. Premium outstanding as at 1st of January 2018 and that 1st of December 2018 was 6 million and 12 million. So you add the balance carried down, which is 12 million. You deduct the opening balance, which was 7 million. Then you factor anything that relates to premium. In our total balance, there are 2 items. We have reinsurance premium paid. So that one is an outflow. You also raise reinsurance premium paid. If we received, you add. And the insurance premium paid was an amount of 4. Then also we had returned premium. Also you deduct. That one is an outflow. Also returned premiums. And the returned an amount of 5. And do you have anything that relates to premiums? Don't think we have. So how much is that? 42, 10, 15. 42 minus 15, you get? Get 27. So that's the net premium. Now, once you have the net premium, you factor other incomes, such as commission. Yeah, commission seeded. Do you have commission seeded? Good. Then you add other incomes such as commission seeded, and commission seeded was an amount of 800. Also, there was a forex gain realized, forex exchange gain. That's an operating income. That one is not a foreign income; it's a foreign exchange gain. So for the bank, that's major of their one of the major their operating activities. So we had foreign exchange gain, which was realized. If it was unrealized, it will not be taxed. So foreign exchange gain realized was an amount of 35. Also, there's what? Reduction in reserves. We see that reduction. So I think we are done with all the expenses now. Now let's deduct expenses. We start with their major expense, and their major expense are the claims. So how determine the net claims? So you'll take the amount of claims paid, then you add claims balance carried down, then you deduct the amount of claims balance brought down. How much was the claims paid? 4,000. Then now let's go to note number 2. In note number 2, I told that claims outstanding as at 1st of January 2018 and that 1st of December 2018 were 600 and 900. So you add the balance carried down, which is 900. You deduct the opening balance, which was an amount of 600. Anything that due to claims. Can you see the claims recovered on reinsurance? Yes. So you also deduct claims recovered on reinsurance. Claims recovered on insurance was an amount of 3,000. Was there any claim expenses? Sorry? Can you see them? Yeah, do you see the legal expenses relating to claims? Yeah, we see that we also add any expenses that related directly to this claim. So we add claim expenses where we had the legal expenses. Yeah, legal expenses relating to claims was an amount of 400. Good. So now give me the net claims. Give me the net claims. $53 minus 36. You get 1,700. Then we deduct other incomes. So let's go back now to the trial balance. We factor in the allowable expenses. One of the allowable expenses we have commission. Commission? Yes, commission accepted is the one which is an expense, and commission accepted was an amount of 20. Then we have foreign exchange gain realized, that's an income. Dividend from life assurance fund, that's an untaxable income. Rental income on commercial building is taxable, but is part of specified sources of income. Bad debt provision, all provision are disallowable, not unless it's a specific bad debt. Investment income, it's also specified sources of income. Reserves for unexpired risk, that one we have to consider the changes. Illegal expenses relating to claims, we have already captured that. Then we have agency fee. Agency fees, an amount of 400 minus. Let's go to note number 4. Agency fee includes 200, which relate to life assurance business. And that one does not relate to this general insurance, therefore becomes a disallowable expense, of which you'll get an amount of 200. Then we have management fees. Management fees, which was an amount of 120. Don't think there was any other adjustment. Repair of rental properties. Now that one is a disallowable expense for the insurance. It will only be allowed or be offset against the rental income. Good. Entertainment expenses. Entertainment expenses, amount of 400. Then we have purchase of furniture. That one we qualify for wear and tear. Purchase of computer, wear and tear. Insurance premium received, return premium. So now let's determine the investment allowance, or what we call the capital allowance. That one is allowable expense. For the assets acquired, number 1, we had acquired furniture. Then we have computers. Can you go to the first page of your past paper? The first page of the 2022. First page, we have the new rates. Furniture you qualify at the rate of 10%. All the computer hardware, computer software at the rate of 25%. So, computer hardware, computer software at the rate of 25% per annum, reducing balance. So you'll take the cost of furniture was 600, 10% will be 60. Then on computer, the cost of computer was 300, 150, you get 70, 75. And that's how you get taxable profit. Now this taxable profit is what we call business income, or the operating profit. Once you get the operating profit, now you can factor in, you add other specified sources of income. Other specified sources of income. We had rental income on commercial building. Rental income was an amount of 1,600, but there was expenses relating to these rental houses. It can be offset. Yeah, repair of rental properties, an amount of 200. So that means now the taxable amount will be an amount of 1,400. That was for commercial, it's not residential. Then, which other income do we have? We had investment income, right? Yeah, we had investment income. For the investment income, let's go to note number 6. Note number 6. There is something we didn't adjust. Can we go to note number 5? Legal fees include 100 relating to settlement of tax dispute. Yeah. This claim expenses, legal expenses related to claim, it was 400, but you're told that 100 related to tax dispute. So it's 400 minus 100. The only allowable amount will be an amount of 300. Therefore, this one will be an amount of 16 or 17 or 18. 18. Now let's go to note number 6. Investment income comprised. There was interest from bank, 850, which is net. Then there was interest from treasury bond. We see that when you're assessing other income, you don't assess the net. Are you together? Not unless you are deducting the expenses. So in this case, we had the interest from bank. Interest from bank. They received an amount of 850. But this is net. If you add 850, that means you'll be taxed again. So you take it back to gross. And there is something I mentioned in last class, and I remember you, I saw you writing it somewhere. So that withholding tax is at the rate of? So that withholding tax is at the rate of 5%, except for the interest and the dividend from circles and cooperatives at the rate of 15%. So interest is at the rate of 15%. If this was net, that means they had already deducted 15%. So how much would be gross? You divide by 0.85, or you say that 850 is the same as 85%. What about 100%? Was an amount of 100 or 1,000? 1,000. Then there was interest from treasury bond, 350, which is gross. So that one was gross. So interest from treasury bond. That was gross, no adjustment. 350. That's how you get. I don't think we had any other income. Yeah, that's how you get. You adjusted taxable income. You have to determine the tax expense. You get a mark only to write 30%. Then of your adjusted taxable profit. Good. I think now you are okay with on how to tax the insurance company. So we can look at that for 1 minute. Then we do another illustration. And then in your notes, I have provided a lot of assignments there. There are 6 assignments. You can just try one. A small break, then we look at on how do we tax life assurance. So that we have two type of insurance business. One was general insurance, which covers against the loss of property, and then the other one was the life assurance. So take out your notes. I want us to come and discuss on taxation of life assurance. All the notes are in the handout I had shared earlier. So now let's look at taxation of life assurance. So what I'm wrapping is already in your notes, so there is no need to copy again. See that for the life assurance, they cover against the loss of life. So life assurance, putting you there. Now, the gain or profit per year of the income from the life assurance business shall be the sum of the following. So what do we tax? It's in your notes. Taxable income in case of life assurance. Number one, the amount of actuarial surplus determined as per the Insurance Act and recommended to be transferred from life fund for the benefit of shareholders and policyholders. That's one of their taxable income. They don't tax any premium. The amount recommended for the benefit of shareholders and the policyholder. Number two, any other amount transferred from the life fund for the benefit of shareholder. Apart from the amount recommended, any other amount transferred from the life fund for the benefit of the shareholders. Then, lastly, number three, 30% of the management expenses. Have you ever had where the expenses are taxable? Where the expenses becomes an income of which that income will be taxed. So that means for life assurance, they don't tax the premium. They tax any amount recommended for the benefit of the shareholder or 30% of the management expenses, which are excess of the maximum limit. So let's go through that. 30% of the management expenses and commission that are in excess of the maximum amount allowed by the Insurance Act. So apart from the amount recommended for the benefit of the shareholder, 30% of management expenses in excess of the restricted limit. What is that limit? The management and agency fee are restricted as follows. For the first 5 million at 25%, next 7.5 million, the rate increases by 2.5%. So it will go to, I'll reduce this by 2.5, it will be 22.5%. The next 7.5 million, you minus 2.5%, you get 20%. Then the next 10 million at the rate of 17.5. And then anything now, you see, if you add all these, you get that. So anything over now 30 million at the rate of 15%. That's how they are restricted. Good. So you're saying that is 30% of the management expenses and commission that are in excess of the maximum amount allowed by the Insurance Act. Good. So I want us to do that illustration. One for December 2010. December 2010 question 5A. You can still use the one in your notes. It's the same question. I'm a very good teacher. I have indicated the question for you and the solution. Now let's go through that question. The following information relates to ABC Limited Life Assurance Company for the year ended that 1st of December 2009. So there is someone asking for those who missed last class, how will they get the recorded video? So if you're an online student, that means you must be having access to the videos. Just sign in the app. We don't share the videos we record this semester. What we record this semester is what will be uploaded next semester. In case you miss a class, just log in your app. What we are teaching here is the same thing, it's the app. So we usually don't share what we teach here. It's either you attend a live Zoom class. In case you miss a live Zoom class, don't ask for any recording. Are together? You already have the app. Just sign in the app. All these materials we are teaching here, they're already in the app. So I told that the following information related to ABC Limited Life Assurance Company for the year ended that 1st of December 2009. The fund balance was valued by an actuary at 200 million as at that 1st of December 2009. 40% of this fund balance was recommended to be transferred for the benefit of shareholder. So that means 40% of that 200 will be considered as a taxable income. Number 2, analysis of life assurance premium during the year was follows. Now that information for tax purposes is irrelevant. You see that for them, they are not concerned about the revenue, the premium you received. They are only concerned for tax purposes with 2 items. The amount recommended for the benefit of the shareholder, and then the excess management expenses. So number 2, I told that analysis of the life assurance premium during the year was as follows. So we have received during the year, outstanding at the beginning and at the end. That's irrelevant. Then number 3, management expenses and commission paid during the year amounted to 20 million and 4 million respectively. The management and the commission paid was 20 and 4. So the total was 24. So we need to restrict anything in excess of that with tax. The company had no other income during the year required. Taxable income of ABC Life Assurance for the year ended that 1st of December 2009. So this was ABC Life Assurance computation of taxable profit or loss for the year ended. Now the year ended on that 1st of December. We see that for the taxable income, it's any amount recommended for the benefit of the shareholder. So let's go back to note number 1. Note number 1. I've been told that the fund balance was valued by an actuary at 200 million as at that 1st December 2009. 40% of this fund was recommended to be transferred for the benefit of shareholders. So for the taxable income, we have amount recommended for the benefit of shareholder. 40% of how much? Of 200. What do you get? You get 80? 80. Then 30% of the management expenses in excess of the restricted what? Limit. How much is that? So how much was the total management expense? Yeah, total management expenses and commission. Now let's go to note number 3. Number 3, I told that management expenses and commission paid during the year amounted to 20 and 4 respectively. So it's 20, you add 4, the total amount was an amount of 20. We restrict this so that to determine how much was the excess. So restricted or the maximum management expenses. This is how we restrict. The first 5 million, 25%. So we take 25% of the first 5 million. What do you get? You get 1.25. Then the next 7.5 million at the rate of 22.5%. So you'll take 22.5% for the next 7.5 million. What do you get? 687.5. The next 7.5 still at 20%. So we'll take 20% of the next 7.5 million. 1.5. But remember the maximum was how much? 24. So can you deduct? Okay. 5, you add 7.5, 7.5. This is 15. That's 20. So how much the remaining? Yeah, the remaining amount is an amount of 4. So the next 10, but in this case, we don't have 10. We have how much? 4. It would be the rate at the rate of 17.5. So we take 17.5% of 4. 0.7. Now, how much would be the excess management? You take 24, you deduct all that. The maximum, the excess is 18.862. Now, this is the excess management fee. Now, this is not what will be taxed. It's only 30%. Are you together? 30% of the management expense in excess. So this excess management expense, you only tax 30% of it. Forget? 87. 65. 875. Good. So now how much will be now our taxable income? So we take 80, you add this, you get an amount of 85.86587. If you are to determine now the tax expense, you just take 30% of 85.65875. You get 25 point. That's how we determine that. So you can look at that for 2 minutes. Now let's look at taxation of long-term construction contract. Yeah, what are those long-term construction contracts? Now, these are contracts which takes more than one financial year before they are completed. So in this case, how do they determine their taxable amount? Or how do they determine the amount in order to determine the tax liability for the period? So we're saying that there are long-term construction contracts which takes more than one accounting period before they are completed. The income is determined on an annual basis for each contract. If you're given contract for 4 years, so that means you complete the contract at 4 years. But remember, you need to file the returns annually, right? So how do you determine that profit that you need now to file the returns? So we have two methods you can use to determine that. So there are two approaches used to determine the taxable income. One, so we have those methods. One, you can use what you call the percentage of completion. Percentage of completion method. And then number two, where the value of work certified. Value of work certified will be recognized as sales. Those are the two methods you can use to determine the amount of taxable income. Good. So now let's start with the first one. Percentage of completion method. A percentage of completion method. Now, under percentage of completion method, this is where you can determine the profit as the contract progresses. And how to determine the stage of completion. So when determining the percentage of completion, this is how you estimate by to determine the percentage of completion. You take the cost incurred to date. You divide by the total cost. And then you multiply by 100. That's how we estimate the percentage of the progress. Now, once you get the percentage of completion, how to determine the amount of revenue to recognize? So to get the amount of revenue recognized, you'll take the percentage of completion, you multiply by the contract price. That's how you determine now the amount of revenue to recognize. You take the percentage of completion, then you multiply by the contract price. So how do you determine the taxable profit? Now, this will determine the taxable profit. You'll be taking the cost to date. Then you add any estimated additional cost. Any estimated additional cost. If you take the cost to date, and then the cost you're estimating to additional cost you expected to spend so that to complete the project, now that's how you get the total cost. Now you can use that information now to determine the percentage of completion by taking the cost to date, you divide by the total cost. Once you get the percentage of completion, then use that information now to estimate the amount of revenue recognized. Then how do we get the profit? To get the profit, you take the revenue recognized, you deduct cost incurred to date. So that if you take revenue, you raise the cost, you get the gross profit. Gross profit. Once you get the gross profit, then you can deduct any allowable expenses. Allowable expenses, and that's how you get the taxable profit. As simple as that. Any question before I do an illustration? So open with me, May 2012, question 2. Use your past paper, May 2012. Question 2A. I'll still use that one. May 2012, question 2. May 2012, question 2. Where you are told that Ujenzi Contractors is a firm engaged in property development business. During the year ended that 1st of December 2011, the firm secured 3 construction contracts, namely X, Y, and Z. The firm computes taxable income from the contract on the basis of the percentage of completion method. The information relating to the 3 contracts is as follows. So, number 1, the total allowable expenses for the 3 contracts amounted to 500,000. Okay, before that, we are given the contract price for X, Y, and Z, the cost of work certified to date, estimated cost of completion, then additional information. The total allowable expenses for the 3 contracts amounted to 500,000. The firm allocates expenses on the basis of contract price. The firm received interest income on housing development bond amounting to 960 during the year. The firm also received dividend from investment amounting to 1360, which is gross. Required. Determine the following for the year ended that 1st of December 2012. So can you read that question again? That question again. So now let's do that illustration. Now, number one, we are to determine the following for the year ended that 1st December 2011, the taxable profit or loss for each contract. Now, we're using the percentage of completion. So how do we evaluate that? So we have three contracts. We have contract X, we have Y, we have Z. First of all, you estimate the percentage of completion. How do we get percent of completion? First of all, you take the cost to date, you add the estimated additional cost, and that's how you get the total cost. So we have the amount of cost of work certified to date. So we had an amount of 400, we had 720, and then we have 1200. Then we have estimated cost of completion. For X, for us to complete, we need an extra 440. Why we need an amount of 560, and here we need an amount of 200. So how much will be the estimated total cost? Here we'll get 840. This one will get 1280, and here we get an amount of 14. Now with the total cost, now you can be able to estimate the percentage of completion. So that to get the percentage of completion, you take cost to date, you divide by the total cost. For example, for X, you'll take 400, you divide by the total cost at 40, you multiply by 100. Here you take 720, you divide by 1280, multiply by 100%. I will take 1200, divide by 1400 times 100%. Contract X we have 47 point. Let's work with 48%. Here we have 56%. 80. Let's work with 86. Now, once we have the percentage of completion, now, for example, this is what it means. X, you are 48% through. So that means you can recognize 48% of what you had charged for the contract. That's how you get what we call the amount of revenue recognized. See that to get the amount of revenue recognized, you take the percentage of completion, you multiply by the contract price. How much had we charged for contract X? 1200. So that means project X, you are 48% through. So for what you had charged, now you can recognize 48% of that. Here you take 56%. The contract price for Y was an amount of 1800. And here it's 86%. And the contract price was an amount of 2000. What do you get? 576. 1008. 1720. Now let's determine the taxable profit. So how to determine the taxable profit? So this is urgency contractors. So to the income statement, you start by recognizing the revenue. So you factor in the amount of revenue recognized. Then you raise the amount of cost to date. That's how you get the gross profit. Then you can deduct any allowable expenses. We already have the amount of revenue recognized. We have 576, 1008, 1720. Then you raise the cost to date. We already had the cost to date. At 400. Here we had 7. 20, and here you had an amount of 1,200. That's how you get the gross profit. Now that's our gross profit. Then you can deduct allowable expenses. Now let's go to note number 1. Note number 1. The total allowable expenses for the 3 contracts amounted to 500. That's the total for the 3 contracts. How was it allocated? The firm allocated expenses on the basis of the contract price. On the basis of contract price. We have X, Y, and Z. How much is the contract price for X? 1,200. Y? 1,800. Then we have 2,000. That's 3. You get an amount of 5,000. So you get the proportion. 12 over 5. 0.24. 18 over 5. 36. 2 over 5. 0.4. Then the total allowable expenses was an amount of 500. So we apportion. You get 120, 180, and then you get 200. Good. So for X, the amount of 120. Here we have an amount of 180. Here we have an amount of 200. That's how we get our taxable profit. Here you get an amount of 56. Here you get an amount of 108, and you'll get an amount of 320. Now let's go back to the required. So what was the question? Number 1, the taxable profit or loss for each contract. So you have computed that. Number 2, total taxable profit or loss for the firm. Now we tax the firm. This was for each contract. For the firm, you just add the total. So you add the total profit, that is 56. You add 108, you add 320. What do you get? 480. Then you add other specified sources of income. Other incomes. What did we add? Number 1, the firm received interest income on house development bond amounting to 960. So we have interest income, an amount of 960. Also, we had the firm also received dividend from investment amounting to that in 60. But we say that apart from the dividend from SACCO and cooperatives, they are known as non-qualifying dividend. All other dividends, they are final. They are called qualifying. So they are final. So if they are final, they will not be taxed at the hand of the recipient. The withholding tax becomes final. So how much? Msamia. Julia. At 2012, question 1C. 1C. We are told that Sakata Contractors Limited has been in construction business for many years. The following information related to one of its construction contracts for the year ended that 1st December 2011. So now we are doing the second method where work certified will be considered or will be regarded as the value of the sale. So we have the balances as at 1st of January 2011. Now that means at the beginning of the year. So those are the opening balances. We have material on site, accrued wages, rent paid, plant written down value. What do you mean by written down value? You see in financial accounting, if you take the cost minus depreciation, you get the net book value. Then for tax purposes, if you take the cost minus capital allowances or wear and tear, that's what we call the written down value. Written down value. Good. Then we have transactions during the year. There was material sent to site. There was plant purchased, wages paid, inspection fee, subcontractors fee, consultancy fee, material sold, cash or labor, head office expenses, depreciation, which is a provision, rent paid, which is non-contract related. If the rent paid is non-contract related, that means it's not an operating expense, therefore becomes a desirable expense. Good. Then we have other expenses which are allowable. Value of work certified in a year. Can you put a star there? Put a star there. Yeah, the value of work certified during the year. So you see that where the value of work certified during the year will be regarded as the value of the sale or the revenue for the period. Then we have the cost of work uncertified. Then we have the cash received from the client. Then we have the balances as at that 1st December 2018. Now those are the closing balances. We have material on site, accrued wages, rent accrued. Additional information. Wear and tear allowance is at the rate of 12.5%. The company recognizes 2/3 of the annual profit when they arise. Any contract losses are recognized in full in the year of occurrence. Required contract profit or loss for the year ended that 1st December 2011. So how do you determine that? So this was Sakata contractor. Computation of taxable profit or loss. For the year ended 31st of December 2011. So it starts with the incomes. So for the incomes, say that their major source of income or the value of work certified will be regarded as the value of the sale. So we had value of work certified during the year, which was an amount of, it was an amount of 120. Then we raise allowable expenses. If you take sales, you raise cost of sales. How do you get the cost of sales? Opening stock, you add purchases, you raise closing stock, right? Good. So we raise expenses. For allowable expenses, we start with the cost of sale. You take the opening stock. We have the material on site. So give me the material on site. Balance brought down. Material on site. Balance brought down. That's the equivalent to opening stock. So we have the balances as at 1st of January 2011. Material on site was an amount of 30,000. You take the opening stock. Then you add the purchases. Now let's go to transaction during the year. For transaction during the year, the first item we have is material sent to site. That's equivalent to purchases during the year. So you add material sent to site. In short, we want to determine the cost of material during the period, which was an amount of 100. If you take the opening stock plus purchases, what do you get? Closing stock. Open, don't mind us. If you take the opening stock, you add purchases, what do you get? Goods available for sale. Now, of the goods available for sale, for the transaction during the year, there was amount of material sold. Can you see that? Yes. Can you see material sold? Yes. So if you take the opening, you add the purchases, you get goods available for sale. Then, of the goods available for sale, they sold some materials. Material sold. How much was it? 1,500. And then now you can deduct the closing stock. Material balance carried down. Now let's go where we have balances as at that 1st of December 2011. Can you see the material on site? We had an amount of 50. So 130 minus 51,500, how much do you get? $78? Yeah, 78,500. So we have started with the cost of sale or the cost of material during the year. Now let's factor in other expenses. Let's go to the transaction during the year. For the transaction during the year, number one, you had material sent to site. Plant purchased. If you purchase a plant is an asset. Asset will qualify for wear and tear. Wear and tear. We had wages paid. So we have wages. The wages paid was an amount of 8,000. Let's go to the closing balance. Balances as at that 1st December 2011. Can you see the amount of wages accrued? Which is an amount of 4,000. Minus, let's go to the opening balance. Can you see the accrued wages? An amount of 2,000. What do you get? 10,000. I want you to understand this. When you're accounting for the expenses for the year, in case it's an accrual, you'll take what was paid plus what we have incurred but we have not yet paid by the end of the year. You add the balance carried down. You deduct the opening balance because the opening balance is an expense that did not relate to this financial year, related to the last financial year. You raise the balance brought down. In case it's a prepayment, in case it's a prepaid expense, you'll take what was paid during the year, you add the balance brought down, you minus the balance carried down. Can you note this one somewhere? Note it somewhere. That for the expenses, in case it's an accrued expense, you take what was paid during the year, you add the balance carried down, you deduct the balance brought down. In case it was a prepaid expense, you take what was paid during the year, you add the opening balance, you deduct the closing balance. Good. So that's why for the wages, I've taken the wages paid, I've added the balance carried down minus the opening balance. So that means the wages for the year was an amount of 10. Now let's go back to the expenses. We also had inspection fees. Inspection fees, an amount of 2,000. Also, there was subcontractors fee. For the subcontractors fee was an amount of 1,000. Consultancy fee. Consultancy fee was an amount of 3,000. Also, we have cash or labor. Yeah, those are the wages, an amount of 2,000. Then we have head office expenses. Now, head office expenses, are they allowable or disallowable? They are allowable. You know, most of the head office, they don't operate. Right together? Yes. So, for example, if you take a case of a supermarket, most of the head office, they don't operate. Yeah. So it is being financed by the branches because mostly the head office is the one managing all the other. That's why maybe the chief accountant is the general manager. That's where they are. So in case of the rent, for them, they are not operating. It's other branch to contribute for that. That's part of an operating expense of which they pay on a monthly basis. So therefore, it's an operating expense. Head office expenses. It was an amount of 3,000. We also have depreciation is disallowable, right? Rent paid, non-contract related. That one is a disallowable expense. Then we have other expenses. We have other expenses, an amount of 2,000. Then, now let's go to note number one. Note number one. Wear and tear allowance is at the rate of 12.5%. Wear and tear. You're already given the rate. So don't use the new rate. So use what you are given. 12.5%. Which asset did we have? Plant. Now, let's go to the opening balances. Let's go to the opening balances. As at 1st of January 2011, the plant were given the written down value, which was an amount of 20. Then during, for the transaction during the year, they acquired a new plant. Can you see the plant purchased? At an amount of 10. Now, listen here. Sometimes you'll be given the opening balance, the purchases, and then the balance at the end. You don't take the balance at the end because the balance at the end, they had already deducted depreciation. So you only take the opening balance plus the addition for the year. You subject it to this year. You don't take the balance carried down, not unless the purchases were purely made during the year. So 12.5% of 30,000. Sorry? That's 750. Now, can you add for me the total expenses? Starting with the material cost, add the total expenses. You get an amount of 105 to 50. Good. Now let's go to note number. Now, before we go to the note, in the transaction during the year, the second last item, there was amount of cost of work and certified. Can you see that? Cost of work and certified. Now, the total cost was an amount of 105. But you know that of that 105, 20 was uncertified. So you deduct. In short, not all the 105,000 will be allowed. Only which was certified. So you raise cost and certified. 20,000 was not certified. So you minus you minus 20, what do you get? Sorry? 250, eh? Yeah, so therefore, to get the amount of profit, you take value of work certified, you minus the cost certified. And that's how you get the profit. You get that form? 750. Therefore, to get the taxable profit, you take 2/3 of 34,750. What do you get? $23? 167. So if you are to get the tax expense, you just take 30% of 23,167. You get an amount of? Any question? Yes. Haujauliza swali, mimi hata sijasikia kenye umesema, umepoint tu. 2/3, eh? Now 2/3 means 2/3, si ni kweli? Ya nini? Haya, si tulisoma swali na nyinyi? Soma number 2. Number 2, you are told that the company recognizes 2/3 of the annual profit when they arise. So in short, the recognized profit is 2/3 of the profit. So that's why to hear the taxable profit, I've taken the 2/3 of the profit of the year. So I want us to do a question on taxation of airlines. Now in your notes, I have provided another illustration on construction contracts. That one for November 2019. You can go and do it, then you mark for yourself. Then there is a small mistake I have done there. So go and try to determine what is the mistake I have done there. Just one item. The question is your note, the last page. So I want us to do a question on taxation of airlines. But the notes are shared later on the other document. I told you for tax what you need to know. It's all about allowable and disallowable expenses. Allowable and allowable expenses. Open with me, May 2018, question 4A. And we return it. May 2018. Jet Air Safaris Limited is a foreign company operating a fleet of passenger and cargo aircrafts in Kenya, Middle East, and Far East. The operating results for the year ended 30th of September 2017 are as follows. So we have the income from cargo flight, Kenya, China, income from passenger and flight, Kenya, Middle East, income from passenger and flight, South Korea, Kenya, income from cargo loaded into aircraft on all routes, salaries and other expenses, accumulated depreciation on aircraft, general provision for bad debt. A general provision becomes a disallowable expense until they are specific. Added information. Salaries and other expenses include there was purchase of plane engine. What do you call that expenditure? We're discussing about allowable and disallowable expense. One of the disallowable expenditure was what? Capital expense. And I remember giving you an illustration. If you Use of airport facilities, which was an amount of that 400. Then there was hotel bills for first class passenger. Allowable, disallowable? Allowable, that's an operating expense. Yeah. So hotel bills for first class passengers. An amount of 37,800. Then there is accommodation for air and crew. Also, that one is allowable expenses. Accommodation for air and crew, an amount of 10,800. Then we go back to the expenses. There was accumulated depreciation on aircraft. Depreciation is a desirable expense. General provision for bad debt. Also, that one is a desirable expense. What else do we have? Hey, which other expense we have not yet captured? The accommodation is 9,000. Oh, accommodation is 9,000. Accommodation is 9,000. Also, there is gifts. Yeah, gift to airport staff. Yes, that one is allowable. See, that's more pay. Now, if we decide to entertain our students to pay water, to pay sweets, to pay anything, past paper, is that part of or flowers? Is that part of an operating expense? Yes, that's an operating expense. Now, in this case, we have gifts to airport staff. This is an airline. That's their working environment. So that's only an operating expense. Expense. Yeah. So you also have gift. Where was your gift to airports. Staff. Amount of 10,800. Also, we have investment allowance or the capital allowance. So now let's provide for capital allowance. Now for capital allowance, we have two assets we need to provide for. Number one is the aircraft. As well as there was the plane engine. Now let's go to the first page of your notes. Aircraft, ships, vehicle fire at the rate of Can you see part B? Yeah, the third bullet, ships or aircrafts. It's at the rate of 50% for the first year of use. So for the aircraft, it will take 50%. Also, plane aging the same 50%. Now let's go to note number 2. Note number 2. The airline has a fleet of 4 aircraft whose total cost before accumulated depreciation was 360. Now that was the original cost. So you multiply by 360, you get an amount of 180. Also, there was plane engine, an amount of 117. 50% of that you get 16 or 50. Sorry, 55. 58,500. So now give me the taxable profit. The taxable profit. Now for salaries and wages, I've just taken the salaries. I've deducted all the other expense provided in note number 1. You see, we are given the salaries and other expenses. So what I did, I only took the salaries. I take 1548. Then I told that salaries and expenses include. So I deducted all the other expenses, and then you allow them on an individual basis. I hope that's well answered. How much is the taxable profit? Sorry? That's 295. 200. Now let's work with this. So how much will be your tax? Give me the tax expense. 958, 988. You take that in? 37.5% of 329,500. And I told you the teacher is always right. Eh? Can you go to the first paragraph of the question? You have been told that Jet Air Safari Limited is a foreign company operating. Can you underline that? Foreign. Okay. So that for non-resident company will be taxed at the rate of 7.5. So I think we can call it a day. So I'll share the notes for the next session. Come with them printed, not the soft copy.